What's up, everybody? Logan Burchett over here from Forecaster today, talking about everybody's favorite topic, which is cash. And specifically today, what I want to talk about is how to not run out of cash. But I'm going to attack it from a little bit of a different angle this time. I want to talk about the 9 most common ways that companies tend to run out of cash. So we're kind of going to be talking about it on the opposite side. What are the things that we've seen? What are the most common mistakes that founders make that are avoidable that end up leading to a cash shortfall? So we got 9 of them for you here today, and I'm going to go through them and explain why these are so prevalent, why these are so common, and how to avoid them. So we're going to kick it off with the first one, which is not hitting your growth targets. So essentially not selling enough, not generating enough revenue, not growing fast enough. If you don't generate enough revenue, if you're not selling enough deals, then that's going to stifle your growth and lead to the bottom line and end up in you depleting more cash than you expected. Now, this is especially true if you don't cut back expenses with the lack of revenue growth. So if you have expenses based off of some revenue targets and then you don't hit those targets, but the expenses stay roughly the same, that is going to lead to you overspending and thus falling short on cash. And if you don't keep that in check, then that will eventually cause you to run out of cash. The next mistake that we see founders make is simply raising money too late. So this is especially true with founders that maybe haven't raised a lot before and they've raised a big round of funding, maybe a couple of $1 million, and they ratchet up their spending in accordance to the expected growth. And then what tends to happen is they come up towards the end of their runway. They maybe have 3, 4, 5 months left, and they neglect to raise until the last second. They don't start raising that next round of funding until maybe they've got a couple months runway, like 2, 3 months worth of runway. That's simply not enough. Your back's up against the wall at that point in time, and it's really, really hard to negotiate whenever you're up at the end of your runway. Whenever you've only got like a couple of months worth of cash left, investors can smell that. It makes it really, really hard for them to get bought in, and it shows that you didn't properly manage and you weren't a good fiduciary of their money. So just whenever you're thinking about when the next time is to fundraise, budget probably about 6 months in your mind. It's going to take about 6 months to get the round completely done from start to cash in the bank account. Don't wait for your end of your runway when you only have a couple of months left. That's a major mistake that we see founders make all the time. The third mistake is also related to fundraising, which is simply not raising enough money. So a lot of times what we see is founders budgeting their next round of funding based off of really aggressive revenue projections. And so because the revenue projections are so aggressive, the cash shortfall that is projected in their financial model is much lower than it actually will be. So that leads them to not raising enough capital and then not being able to hit their targets and then not being able to raise subsequent rounds of funding. So the way to avoid this is pretty simple. It's just generally raise more money than you think that you will need to raise. So one of the things that we advise all of our clients to do is budget a low growth scenario, kind of a worst case scenario, projections that you are very confident that you could beat, and then throw a buffer on top of that, maybe a 30 to 50% buffer on top of the cash that model says that you're going to need. And you want to budget for 18 to 24 months worth of runway. That's 12 to 18 months worth of execution, and then 6 months of fundraising, given what I just said, which is you want to budget at least 6 months and make sure that you start that fundraising process before you hit the end of your runway. So just raise more than you think you need. The fourth reason that founders tend to run out of money is they simply burn too much money too fast. And not to knock the West Coast startups out there, but this is very much a West Coast mentality of just raise a ton of money and then ratchet up your burn, grow your team, spend a lot in order to try to grow. And this works for some companies, but one of the problems that we see, and that's very common with this type of approach, is whenever you go out and hire a lot of people and you really increase the level of expenses that you have and you don't see that growth, all of a sudden you've got a really, really high burn rate. And it's kind of like steering a cruise ship. It's really hard. It's not very nimble. It takes a while for it to actually turn around. And the bigger you are, the higher your burn, the more you're like that cruise ship that's harder to turn. It's harder to right the ship. So by keeping the burn at a manageable level and staying nimble and hiring and growing expenses in accordance with revenue is the best way to avoid this. The fifth mistake that we see founders making is simply not having a backup plan. So this goes back into scenario analysis, back to having a worst case scenario, but essentially having a plan for if your growth is not what you expect it to be. If you're not growing as fast as you want and you're not meeting expectations, have a backup plan. Have expenses that you're going to be able to cut, or perhaps hires that you're going to be able to push off. Just if things aren't aren't going according to your plan, according to your cash flow forecast, change that forecast. Have a plan that works for you and your business. So scenario planning is the best way to mitigate this step. The sixth mistake that we see founders make are over allocating or under allocating the resources needed for them to achieve their goals. And usually what happens here is they under allocate based off of their growth projections. So if you have really ambitious revenue projections, let's say, and you want to triple, quadruple, whatever it is in terms of revenue, and you're not giving the team the resources it needs in order to facilitate that growth, you're going to run into issues, which is going to cause you to spend more money. So you can imagine if you are growing revenue significantly and maybe you're not budgeting for a subsequent paid ad spend, or maybe SDRs or AEs in order to close those deals, you're going to find out eventually in the real world that you really do need those expenses and they were unexpected, and that's going to cause burn to be higher than you wanted it to be. Now, the best way to mitigate this risk is by getting full team buy-in into your forecast. So one of the things that we advise clients on all the time is once you have a forecast that you want to stamp, that you want to manage your company to, you want to share that with the entire company, and especially the stakeholders that are in charge of hitting these numbers, like your sales team, your marketing team, and things like that. Make sure they're comfortable with it, but also make sure that when they look at the expenses that are allocated and what you're expecting to spend on their departments, that they feel like they're going to be properly resourced in order to hit these goals. The seventh mistake that we see is kind of a tragic one, and that is bad deals or bad investors. So we see this, it's probably one of the more rare ones on this list, but it's worth noting, especially whenever founders go out and raise a lot of debt with maybe very high interest rates that are really adverse to the company. Then investors, other investors, whenever you need to raise additional capital, if it's a lender, they might not like being lower down on the capital stack and they might not like the debt that you have in place. Or if it's another investor, they also might not want to be put behind the debt, because in an exit, debt gets paid out first. That puts them lower on the capital stack as well. So that's one mistake we've seen. We've also seen on the equity side, people just getting into bed with the wrong investors. People that maybe they don't have a lot of experience investing, and whenever things aren't going great, they really hemorrhage the company's growth. They make your job a lot harder, and in some cases, they might even try to claw that money back, and that can really hamper growth, and it can distract you, and it can just all around be a nightmare. So the way to avoid this is just to have a very high level of scrutiny into the capital that is being put into your company, be it debt or equity. If it's debt, make sure that you're very comfortable with the terms, socialize it with people that you know and are comfortable with the space. This is one of the reasons why we have fractional CFO services at Forecaster, is to help comb through term sheets of debt and make sure that this is a good deal for the company, as well as just being ruthless in who you let on your cap tables. So just make sure that you thoroughly vet investors, you feel very comfortable with them, you interview other portfolio companies that they've worked with. All of this is going to really help make sure that you have a clean ownership structure in your company. The eighth issue that we see whenever it comes to burning too much cash is simply hiring too many people too fast. Now, this is very much related to ratcheting up the burn too quickly, so essentially burning too much too quickly. But in this one, I especially want to call out people, because people are very difficult if you've overhired to cut down on. So whenever you have to cut down on your personnel expenses, not only are you having to put people out of a job, which is kind of an emotionally hard thing to do, but it also usually takes a decent amount of time. If you do it the correct way, you're going to want to put them on a performance improvement plan. You're going to want to give them plenty of heads up. You're probably going to want to give them severance packages depending on the situation that you're in. So if you cut people the right way, then it can be very expensive. And then if you cut people the wrong way by just kind of kicking them out of their job without them expecting it, then it can damage your reputation. So both things are not good, and both things can lead to issues with cash flow. And then the ninth and final thing is essentially just not having enough of a buffer and having absolutely no margin. So people, whenever they plan their fundraise, they look at their fume date, they look at when they're going to be essentially out of cash, and they back out from that when they should start raising, like 4 to 6 months from that date. But really what you would like to do is plan for a anticipated close date on your equity that leaves you a buffer that you're comfortable with. And that might be, it's different for different companies. For Forecaster, we like a $300,000 to $500,000 buffer. So we like the idea of our cash never getting below $300,000 to $500,000. Even when we're closing a new round of funding. That way, we've got 6 months to fundraise, but even if something goes catastrophically wrong, we still have a buffer that we can use in order to make sure that the company doesn't die and figure things out. And it's just good practice. Just make sure that you're always fairly comfortably arm's length away from your fume date. So those are the 9 ways that companies tend to hit their fume date, run out of cash, and die. Hopefully you found this topic interesting and useful. And if I glossed over anything, if there's something that you wish I would have gone deeper on, on, please leave that in the comments below, and we will follow up and do additional content that addresses any of the things that you think would be useful to talk about. We're going to drop a few resources too in the description. We have templates that help you plan cash flow and so on and so forth. And if you're interested in taking a look at Forecaster, which can help you mitigate all of these risks, we're going to have a link below to get in touch with us as well. So thanks for watching. As always, happy forecasting.